Okay, good afternoon and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And once again, we are about to enter another earnings season. First of all, I just want to say a happy new year to everyone. I hope everyone has had a happy and safe holiday. I'm really looking forward to being back here, doing more education with you guys and kind of kicking off this particular year talking about earnings season. This is likely going to be a fairly interesting earnings season as we're starting to see some weakness from the equity market. So we want to talk a little bit about what have we seen in the previous earnings season? What are expectations for the upcoming earnings season? And some of the tools that I use personally to navigate the earnings season that you can leverage for your own trading, and specifically how to utilize options to potentially trade an earnings idea that you might have. So before we get started, what we are going to discuss here is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any of the specific securities that we are going to discuss during today's session. So we will start off by taking a look at the Q4 earnings preview. We'll take a look at, generally speaking, what are analysts' expectations for the upcoming earnings season. We'll also talk a little bit about what we saw last quarter. And then we'll talk a little bit about the option strategies that you can trade for the upcoming earnings season. And the most important part where I want to spend some time here today is understanding options pricing around earnings. Many of you may have a basic understanding of the option strategies and generally how they work, but there are a few additional elements that are important around earnings for you to understand in order to best utilize these options for your portfolio. So I'm going to discuss what those things are and give you some specific examples. And then I want to talk a little bit about earnings research. I get this question a lot. How do I know whether a stock is going to beat or miss earnings? The answer is you don't know, but there are some things that you can do to research to give you some ideas and some thoughts. And I want to share with you what I research before I inform my decision as to whether I think a stock may beat or miss on earnings. And we'll go through some live examples during today's session before I open this up for Q&A. But the primary question that I want to help everyone understand is, how can I research and trade earnings season with limited risk using options? So let's first kick off by talking a little bit about the upcoming earnings season. Now, I think it's best to first take a look at what we saw last quarter. So last quarter, which was the Q3 earnings, we saw a 39% increase in earnings per share versus the previous year. Now, remember, previous year, Q3 of 2020 was a pretty poor year because of the start of the pandemic. So a 39% year over year increase was, it sounds high, but it's because the base was fairly low from the previous year. But the important part is that consensus was that we were going to beat earnings was going to increase by about 28%, but we actually came in at about 39%. So corporate earnings were stronger than analysts were expecting. Now, this is bottom line, meaning in terms of earnings, but top line in terms of revenue. Expectations was that sales or revenue was going to be 14% higher than last year. It came in slightly higher than that at 16% higher than previous years. So when we look at Q3, this was a quarter where the market beat what the analyst expectations were for that particular quarter. And 10 out of the 11 sectors ended up beating consensus, with energy being the top sector from last quarter. And the one thing that I want to say is that only 58% of S&P 500 companies were able to beat both top and bottom line. So this is a number that's relatively low, with only 58% of companies beating both sales and earnings numbers. This is on the lower end of the spectrum, if you will, of percentage of companies that beat on both top and bottom line. But the real metric that I think we need to pay attention to more than anything else is the fact that stocks that beat their earnings expectations only gained on average of about 31 basis points the next day, meaning stocks that beat their earnings did not move higher by very much. On the flip side, stocks that missed their earnings declined by an average of 1.64%. That is a significant skew between how stocks perform when they beat versus how stocks performed when they miss. And that is telling of just where markets are with respect to the earnings expectations. And from my perspective, this is a trend that has already been in place for a couple of quarters already. This is not the first time we're seeing this in Q3. We saw the same trend in Q2, where stocks that missed on earnings had significant further downside than stocks that beat with upside. So what this simply means is that if you're going to trade earnings, you will likely have a better chance of seeing a big move on stocks that miss versus stocks that beat. So this kind of skews your research when you go into an earnings season to say, should I research and look for stocks that are likely going to beat, or should I research stocks that are likely going to miss? Because the stocks that are going to miss may have a better opportunity to potentially profit from those moves to the downside. So when we look at Q4 earnings, the upcoming earnings season, because right now companies are going to report what Q4 earnings are going to be, the market is expecting a 20% increase in EPS. So remember, this is comparing what we're expecting in Q4 of 2021 compared to Q4 of 2020. And remember, Q4 of 2020 wasn't a particularly great year. It was certainly the start of the recovery of the pandemic, but it certainly wasn't a particularly great year for businesses, if you will. So a 20% increase in sales, in revenue, 11% increase in sales. So this is a slowdown from last quarter. Last quarter, we were expecting 28% growth and 14% growth on revenue. Here, we're expecting 20% growth in earnings, 11% in terms of sales versus Q4 of last year. And this is really where right now some of the strongest consensus that we see here is across the financial institutions at the moment. Energies and financials are really two of the top sectors that we are paying attention to. So what we look for is stocks or specific sectors, if you will, where analysts have revised their earnings expectations higher, and sectors where analysts have revised their earnings expectations lower. And the sectors that have seen the most upward revisions or the largest upward revisions are financials, energy, and real estate. These are the three sectors where we have seen analysts continuously change what they're expecting companies are going to report on their earnings and revenue numbers, and where they've revised their numbers higher. So these are the sectors where we're likely going to see some strength. And then when we look at the sectors that have seen downward revisions, utilities and communications screen at the top. So when we're looking for opportunities, these are some of the sectors that may provide some of the largest outperformance or some of the largest underperformance when it comes to earnings. Does that make sense to everyone? Please type 1 into the chat window if that makes sense to you. Perfect. Okay, I see a lot of ones. So one of the first things that I do want to take a look at and provide a strong sense of understanding is around how options pricing works around earnings. And this is sometimes, in my opinion, the more difficult part to really understand with respect to earnings. And this is what I call 1 step forward, 2 steps back, because whenever you're trading, or whenever we're around earnings, there are 3 large factors that affect the value of an option around earnings. It's the stock moving, it's volatility, and time. So whenever we're trading options, the reason I call it 1 step forward, 2 steps back is because you have one potential opportunity to get the directional view right, meaning if you think a stock is going to beat and the stock makes a big move to the upside, that's your opportunity to potentially profit. If you think a stock is going to miss and you buy a put option and the stock makes a big move to the downside, that is your opportunity to potentially make a profit. But while you are playing for that opportunity, in the background, there are 2 things that are working against you. That's volatility crush, or what's referred to as volatility crush, and time decay. So I'm going to get into kind of what these things mean, but just conceptually understand there's one thing that can potentially work in your favor if you get the directional view right. And in the background, there are 2 things constantly working against you. So in order to make money or in order to be profitable around earnings, you have to have the stock make a large enough move where the profits from that move will overcome the volatility crush and time decay. Does that make sense? Please type 2 into the chat window if that makes sense to you. And if you don't know what volatility crush and time decay means, we're gonna talk about that on the next slide. But conceptually, it's important just to understand that you need to have a big enough move in the underlying stock to overcome these two elements that you don't really have control over that's working against you in the background, okay? So let's now talk a little bit about what volatility crush and time decay actually means. Well, sorry, actually, before we do that, I do want to clarify. I apologize. I skipped ahead. What I just referred to, this is for when you're buying an option. So if you're buying a call or if you're buying a put option, you have the ability to potentially make a sizable move that is going to turn the trade into a profitable trade. And at the same time, you have these two silent things working against you in the background. On the flip side, you can sell an option going into earnings. And when you sell an option going into earnings, what you have is 2 steps forward and 1 potentially massive step back. So it's really, one is not better than the other. It's just that they're 2 different sides of the coin. In one side, you have 2 things silently working against you when you're buying an option, and you can potentially overcome it if you have a big enough move in the underlying stock. But if you're selling an option, you have 2 things that are silently working in the background in your favor. But if the move in the underlying stock is opposite to what you expect it to be, then that could potentially set you back beyond what the 2 things that are working in your favor. So when you're selling an option, volatility crush and time decay, those 2 things are working in your favor. But if the stock makes a big move in the opposite direction that you think it's going to move, that could cause a loss that exceeds what you collect from the volatility crush and time decay. So this is really where, when you're selling an option, you want the stock to not move very much so that the losses that you have on the stock itself does not overcome what you're making from the volatility crush and the time decay. Does that make sense, everyone? Please type 3 into the chat window if that makes sense to you. And I just want to clarify, if you're a little confused by this, it's okay. What I'm trying to show you here is that buying options, selling options, these 2 things that you can do going into an earnings announcement, one is not better than the other. Each one has its pros and cons. When you're buying an option, you have 2 things working against you that are silent, that you can't really control. But then you have this one thing that, if you do get the directional view right, you can blow it out of the water and potentially make a big profit. On the flip side, if you're selling an option, you have 2 things that are working in your favor, great, but then you have one thing that could potentially set you back even further. And again, one is not better than the other. It's just a matter of understanding the difference between the 2, and different times you're going to want to apply different strategies, okay? So let's talk a little bit about these, because up till now, we've talked about the move in the underlying stock, we've talked about volatility crush, and we've talked about time decay, but we've only talked about those in conceptual terms. Let's put some numbers around it. Every single option that you trade, there are terms that we call the Greeks. And if you find the Greeks difficult to understand, that you're not alone. But the Greeks are very important in telling you how sensitive the option that you're buying or selling are to different things. And those different things are the 3 things I'm referring to. So you might have heard of different Greeks like delta, vega, and theta. And the delta, vega, and theta of an option simply tells you how sensitive is this option relative to different things. Delta tells you how sensitive the option is to the underlying stock. That's the large move that we're talking about. If you're buying an option, that large move can work in your favor. If you're selling an option, that large move can work against you. Volatility crush, that's what Vega tells you. Vega tells you how sensitive is the value of your option to changes in implied volatility. And the reason that Vega is important is because right before an earnings announcement, the implied volatility in option is going to be elevated because there's a lot of uncertainty around what is going to happen? Where's the financial numbers going to end up? So because of that elevated uncertainty, the implied volatility of the option is naturally elevated. And once the announcement comes out, what you're going to always see is that implied volatility will collapse. It will reduce, and because now that uncertainty is gone, so now that we know what the numbers are, the uncertainty factor is reduced. So the implied volatility will naturally come down. So the question is, if the implied volatility of an option comes down, how does that affect the value of an option? Well, that's what Vega tells you. And lastly, because you're holding the option from one day to the next, right? Whether you buy it the day before earnings and you sell it the day after earnings, or if you buy it 10 days before earnings and sell it 10 days after earnings, the holding period that you hold that option, the value of that option will decay over that time. And theta tells you how fast the value of that option decays by each day that goes by. So if, let's say, you're trading an option, doesn't matter whether you're buying or selling, that option has a delta of 0.5, a vega of 0.25, and a theta of 10 cents, then you can calculate exactly how much you can potentially make from the trade if the stock moves higher, if the stock moves lower, based on volatility crush and based on time. Now, at this point, many of you might be saying, you are in way over my head. This is too complicated. There's too much math. I'm never going to be able to figure this out. And the reality is, I don't expect you to. I'm only teaching you this so that you understand this on a conceptual level. You will never, ever have to do the math. That is kind of the beauty of the internet age. All of the math is being done for you. You have access to the tools that do this math for you. But it's important to understand that these are three external factors that have an impact on your option price. So if you're going to buy an option or if you're going to sell an option, it's important for you to know these things have an effect on the value of an option. How much of an effect? Well, different tools, we have analytical tools that will tell you. But if those analytical tools are useless if you don't even understand these effects on the value of your option. Does that make sense? Please type 4 into the chat window if that makes sense to you. Okay, perfect. So we're going to come back to this. I want to now talk a little bit about, now that we understand, earnings season is coming up, we have some idea of kind of expectations here for earnings season. It's not particularly great at the moment with respect to, there's certainly a slowdown in terms of growth in both top and bottom line in terms of corporate earnings relative to last quarter. We're seeing that we're seeing that stocks that disappoint have big moves to the downside. Stocks that beat are not seeing big moves to the upside. We're starting to learn about how options pricing has changed around earnings season. Let's now take a look at some of the ways that you can research a stock, because a lot of the questions that I get around earnings season, especially for some of you that follow me on CNBC, the question that I always get asked is, how do you know whether a stock is going to beat on or miss on earnings? And the answer is, I don't know, but I do have a set of things that I research to give me and inform my decisions, to help me understand whether or not I think a stock may have a chance of beating or missing on earnings. So I want to walk you through those things. So the first thing I typically look at is a tool called Estimize. This is a tool that you guys can also access at estimize.com. It's free to access if you contribute to the platform. And what it gives you is a sense for what is the market currently expecting earnings to look like versus what does Wall Street analysts currently predict that earnings is going to look like. And right now I'm going to use, this is Wells Fargo. Wells Fargo reports later this week. One of the major banks that reports early in the season, Wells Fargo, Bank of America, JPM, all report this week. With the, in addition to that, you have some of the home builders and some of the airlines reporting. This is a light week with respect to earnings, but we are kicking off at some of the major ones. Financials is certainly always reports early. Wells Fargo reports this week. And as you can see here, the analyst expectations is that earnings are going to come out at $1.04. The market seems to be implying a slightly higher than that, $1.12. This is usually starting, this gives you a sense that, what does the market think that, the company is going to beat analyst expectations, or are they going to come in lower than analyst expectations? So this is one thing that I typically look at. And what you'll naturally see is always the market is always a little optimistic. The question is how optimistic? How much does the market think we're going to beat analysts' expectations? Here, it's going to be about 8 cents, which is not a small amount necessarily, because when you take 8 cents over 4 quarters, that's 32 cents. Multiply that by the 15 times, 20 times earnings a stock like Wells Fargo is trading at. That's a few dollars on the underlying stock itself. So if a stock beats by 8 cents in a single quarter, that can contribute to a sizable gain in the underlying stock's value or the stock's price after that announcement comes out. So this is the first place that I start to look at, is just, what's the market expecting relative to to analyst expectations, and it's not a single thing I look at. It's a combination of multiple things I look at. Wells Fargo, for example, there is a small alpha that the market is expecting relative to what the Wall Street analysts are currently expecting. The second thing I look at is the underlying chart. I typically like to see, how does the stock that I'm currently looking at, how is it performing relative to its sector? So Wells Fargo is, if you look at a chart of Wells Fargo, it recently did break out above this 51.52 resistance level, and it's really started to run away here. It's broken out above this resistance level that has been in place since the middle of this year, since about August or so. 52 has been a resistance level multiple times, and it finally broke out. But not only has it broken out, it also is starting to outperform its sector. And that's what this chart here up above on top here. This is Wells Fargo relative to XLF, the sector that Wells Fargo is a part of. And what you're seeing here is that not only is Wells Fargo breaking out to new all-time highs, it's also breaking out to new all-time highs relative to the sector. So this tells me that it's not just performing well on its own, it's performing well relative to the other banks, or relative to the other stocks in XLF, the other major banks in this. So this is not only a stock that's doing well, because if Wells Fargo is up 10% this month, but every other bank is up 30%, well, it doesn't matter that Wells Fargo is up 10%. It's falling behind the curve. In this particular case, what this is telling me is that Wells Fargo is not only rising, it's getting ahead of the curve. This is usually a pretty good sign going into earnings. You want to see stocks outperforming its sector, or perhaps even outperforming the market going into an earnings announcement. If you're bullish, and vice versa if you're bearish, you want to see stocks that are underperforming its sector. Those are the stocks that are lagging behind. Those are the stocks that may have the opportunity of falling even further behind. Does that make sense? Please type 5 into the chat window if that makes sense to you. And again, every single one of these things on their own is typically not nearly enough information to say, yes, I'm confident that the stock is going to beat, or yes, I'm willing to risk my money and put it on the line to say that this stock is going to beat. But when I look at these things in aggregate, when I see multiple things lining up, that's when I have more confidence in an underlying trade. And even then, even when everything lines up, it doesn't always play out the way that you expect it to. But that's really where where options come in, because options allow me to take a directional view, but do it with limited risk. So if I'm wrong, and the market gets it wrong, the chart gets it wrong, everyone gets it wrong, and sometimes we do, that I'm not risking this huge amount of money going into earnings, because that's always the biggest concern that people have around earnings. You can potentially make or lose money very, very quickly. Okay. So the third thing I look at is basic revenue and earnings trends. So this is simply just understanding, how is the company performing from a financial perspective. Now, you can go crazy looking at the financial statements, but there's a few things that I think are worth paying attention to. It's just the general trend of revenue, right? So if you look at the general trend of revenue, Wells Fargo was making $88 billion in 2016, 88 in 2017, 86 in 2018, 2019, 85, 2020, 72. So this is a stock that was already trending basically in the wrong direction for multiple years. But if you can see here, in the last trailing 12 months, it's now made 74. So we're starting to see this, we're starting to see the revenue numbers start to trend in perhaps a different direction. So that's the first start of just understanding where's the company trending from a basic financial perspective. How much money are they making versus how much money are they making from a revenue perspective versus how much money are they making from an earnings perspective. And that's really where you can also take a look at earnings per share. So as you can see, throughout these few years where revenue was roughly flat and then started to turn lower here, earnings wasn't so bad. Earnings actually grew a little bit. It was pretty bad here in 2020, but everyone's earnings was bad in 2020. But as you can see, trailing 12 months, $4.21. That looks pretty good relative to where we have been here over the past few years. So this is really where, the information that I look at to get a better sense for where are the trends? Are they trending higher? Are they trending lower? Are they trending in the direction that I'm expecting it to go in? Meaning, if the revenue and earnings are trending higher, that just adds to the conviction that I have that Wells Fargo might beat on earnings. But if, let's say, we're seeing multiple years of declines of revenue, declines of earnings growth, that would probably be enough for me to say, okay, this isn't the best candidate for me going into earnings. But Wells Fargo, here looks pretty good from that perspective. So looking at financials is the third thing that I typically look at. And lastly, analyst ratings and research. This usually is never the deciding factor for me, but what is really important for me when I read analyst research is just to understand the business. I can't tell you enough how many times I hear from investors asking me questions about a company, and I ask them in return, what do you like about the company? And sometimes, investors can't even tell me what the company does, and I hate investing or trading in any company where I don't know what the company does and how they make their money. So when you look at Morningstar research, and this is available to all First Trade customers within your platform, is you can take a look at what analyst expectations are going to be. And they have a very deep dive into the business. It tells you what the business does. It tells you how it's doing. It tells you how it makes its money. So how does Wells Fargo make its money? It's important to understand that Wells Fargo makes a lion's share of their revenue from margin interest, meaning the cash that's deposited by people from the bank into the bank, and from mortgages. That's how Wells Fargo makes the lion's share of their business. And this helps you frame, is this the right environment for Wells Fargo to be profitable? Or we have a rising interest rate environment that's good for their business from a net income perspective on interest. And then, how are mortgages doing? Mortgages have been doing great recently. So these are all things that roughly line up with a bullish view here for Wells Fargo. So, these 4 bullet points are largely the things that I use to get a sense for whether or not I think this company is going to beat on earnings. Is this is this bulletproof? Absolutely not. But the more of these things that line up, the higher the probability that I have found that I'm able to research and find stocks that are going to beat on earnings or miss on earnings when all 4 things, or at least 3 out of the 4 things, line up. When I can see that the market is expecting a beat or a miss, I see that it's outperforming or underperforming its sector. I see that the financial trends are moving in the right direction. And I see that I understand the business, and I think that the current market environment that we're in is beneficial for that business. This is my process for researching these ideas, and I hope that this is helpful in giving you a better understanding as to how you can go about finding stocks and how you can think about researching whether a stock is going to beat on earnings. So with that, what I want to do is just take a look at a real example here. Let's look at Wells Fargo. And before we jump into the trade on Wells Fargo, I just want to show you some of the research tools I'm talking about here. You can type in Wells Fargo here, and you can see whether or not the analyst expectations. You can see the full analysis. You can see, as you can see, how much of a breakdown there is. There's a ton here. You can see financial data in terms of the revenue numbers I was referring to, the earnings per share. All of that information is available to you through your research platform on First Trade. So feel free to utilize these tools. They're really helpful in giving you that better understanding that I'm referring to within OptionsPlay. So let's then take a look at placing a trade potentially on on Wells Fargo, if you saw all of this research, you saw that it's beating its market, its sector, you see that it's trending in the right direction with respect to earnings and revenue, you see that the market expectations for earnings is higher than analyst expectations. So let's say you want to take a bullish view here going into earnings for Wells Fargo, which reports on January 14th in the morning. And again, this is purely for educational purposes. This is not a recommendation to go and buy Wells Fargo going into earnings. But I want to show you some opportunities that you can use. And I want to look at buying, let's look at buying a February call option and buying, let's say, a February call spread. And just being able to see these two strategies in play next to each other. And I'm going to compare that to, let's say, selling a strategy. Let's look at selling a short put vertical using a February expiration as well, just to show you what that looks like between the three strategies, because I think it's important to understand the difference between buying versus selling an option going into an earnings announcement. And what I'm going to use is the P&L simulator, because remember how before when we were looking at the Greeks, I was saying that this might be confusing to all of you, especially if you're new to this stuff, but don't be afraid, because we do all of the work for you. Well, this is what the P&L simulator does, is it calculates for you the potential profits and losses based on three things: where the stock goes, by which date, and what the implied volatility of the option is. So you have full control over where you think the stock is going to go, by which date, and whether implied volatility moves higher or lower or stays the same. So I'm going to walk you through how I would use this. So I'm looking at Wells Fargo. It's currently trading at $56. Let's say I think the stock can move another $2 or $3 higher on earnings. Let's say it goes up to $59.50 on earnings. And let's say it does it a few days after earnings. Let's say earnings is on the 14th, and let's say a week later on the 21st, the stock moves up to 59.5. And remember, I said the one thing that you don't have control over is time and volatility crush. So you don't have control over time, meaning how the value of an option is affected by time. And you also don't have control over the fact that volatility will come down after the earnings announcement. So right now, the implied volatility of these options are around 32%. Let's say it comes down to about 25%. There isn't exact science as to how much it comes down by. I usually knock it down by at least a tenth to maybe a fifth of the value of the current implied volatility, and just to get a sense for how each strategy performs. And this gives me a sense for how each one of these strategies will perform side by side. If I bought a call option, if I bought the call spread, if I sold a put spread, how these strategies would perform. And that's really where the OptionsPlay tool is really powerful. It doesn't matter which strategies you use. You can construct any strategy that you would like, and you can use the P&L simulator, and it will show you exactly how much potential profit you have and what the returns on that profit would look like, so that you can make an informed decision as to which strategy is best suited for you. In my particular case, as you can see here, I'm going to make a $171 profit if I bought the call option versus a $59 profit if I sold the put spread versus $117 if I bought the vertical spread. So this really helps me better understand the different strategies and how I would potentially be profitable or how much I have to risk on this underlying trade. So, for me, I think that, either buying the call or selling the put spread might make some sense here. So if let's say I just want a simple strategy, buying the February $55 calls, I can hit the trade button. And one of the best parts about the integration that we have done with First Trade is that I can hit the preview order button, and it will pre-fill the ticket for me within First Trade so that I can send this order off for execution immediately. This is something that would allow me to do this very, very quickly, to go from idea generation using OptionsPlay to sending an order off within the First Trade platform. With that, I hope that this was helpful in giving you a better understanding of the upcoming earnings season and how to go about researching a stock, and giving you a better understanding as to the things that I look at to see whether I think a stock is going to beat or miss on earnings, and how I can set up a trade in options play and potentially execute that here in your first trade account. So with that, what I'll do is I'll open this up for Q&A here at this point. If anyone has any questions, feel free to type your questions in the Q&A section, and I will try to answer as many questions as I have time for here today. And there's a chat window and there's a Q&A window. Please type your questions into the Q&A window, and I will try to address your questions there. Okay, so the first question here by Catherine is saying, rising interest rates are still in the future. How can it be positive for Wells Fargo earnings now? Well, Catherine, Wells Fargo is one of the banks with the largest ratio of net interest margin to their net income, meaning they make the lion's share of their income from interest rates, meaning deposits that people have deposit that they pay virtually zero on, but earn interest by depositing that money with the Federal Reserve. So they make a lion's share of their money from that. So the higher the interest rates are, the more they make on all the deposits, the multiple trillions of dollars that are on deposit at Wells Fargo. So for those reasons, as interest rates rise, that is beneficial for Wells Fargo. And that's part of why the stock is up 10% in the last couple of weeks. Michael is saying, Tony, what time horizon do you typically use for earnings plays? So I'm guessing the question is regarding what time horizon I use in terms of earnings, in terms of options expirations. Generally speaking, 30 to 45 days is as far out as I will go. Sometimes I will go as short as 2 to 3 weeks out, but usually somewhere in that 30-day window is largely where I would use for earnings. And Catherine, thank you so much. I really appreciate that. As you can hear, my new baby boy is screaming in the background. There is a question here. What do you think about a short strangle play in earnings, volatility, crushing, time decay? So, Lee, a short strangle is a trade where, not only do you get volatility, crush, and time decay working in your favor, you get volatility and time decay working in your favor ×2. But, when you're saying you're selling a 2 sigma strangle, meaning you're selling really far out of the money strangles, the amount that you're getting from a volatility crush and theta is very, very small. So even though you're doubling your benefit from these two things, the benefits are pretty small. And at the same time, delta is going to be small as well. So absolutely, it is certainly one of the most riskiest strategies that you can trade, but it is also one where you can maximize the number of factors that are working in your favor, but you only have one thing that's potentially working against you. So it's not good or bad. It's just a matter of understanding the risk that you're taking and the potential rewards that you have for that risk. Lee, thank you so much. What type of option strategy would you utilize if you plan on holding through earnings versus closing out before earnings? So Michael, all of these strategies that I'm referring to is holding through earnings. We're not closing it out before earnings. You open it before earnings and you close it through earnings. So, again, one strategy is not better than the other. It's just a matter of understanding the difference between buying an option and what the benefits are there. Because when you buy an option, your risk is limited, but you have two things working against you. When you're selling an option, your reward is limited, but you have two things working in your favor. So again, one is not better than the other. It's just a matter of what's the risk profile for you that's better suited for you. So what do you suggest for option strategies for earnings play? So for those of you that have followed me long enough on CNBC, over the last 8 quarters of earnings season, I would say the most common trades that I make are going to be debit spreads and credit spreads. And it all usually depends on, how cheap or expensive the options are. When options are expensive, I tend to favor selling options. When options are cheap, I tend to favor buying options. But also when I think the stock's going to make a big move, buying options is definitely going to be the way that I go about doing so, using a debit spread or just buying an outright call or a put. But when I think the stock's not going to make a huge move, meaning I think it's going to beat, but I don't think it's going to make a big move, I prefer selling options on that trade. So, those are the ways that I typically decide. when would it be ideal to enter a trade to hold through earnings? Generally speaking, you want to enter these trades just a few days before earnings. You generally don't want to hold them for a long time before earnings, because a lot can happen before earnings. So usually just a few days before earnings, you enter the trade. So with that covers, what I wanted to cover with you here today. Again, I really hope that this was helpful in giving you a better understanding of how to trade earnings around earnings seasons. I hope this gives you some color around how I research trades for CNBC, and I hope to see you guys here on Friday afternoon, where I'm sure we will be covering some of these earnings names that are reporting next week. And I'll be actually breaking down some of these ideas, specifically my research points on the trades that I make this particular Friday for earnings season next week. With that, thank you so much. I hope you guys have a great trading day, and I'll see you guys here in about 2 weeks' time on our next options education session.